Hello, folks, and welcome back to the Real Men of Real Estate radio show here on KCAA Radio. This is your host, Patrick Franz, and I'm back with my guest, Desi Arnaz, professional investor. And we were just talking before the break about note investing, why it's a great thing, and why it might be a hedge against market turndowns. And I think the ultimate thing is, Desi, since you were a landlord and you realized that not only is it a headache, or can be a headache, but also the actual net returns at the end of the day, once you have expenses and people are calling you about repairs and all the other things, that it became something that was kind of a job, right? And then you look at the stock market, and the stock market, people don't have control over it. You don't know when it's going to crash, how far it's going to crash, and people, can't sleep at night. And then you've gone through all of it. And so now you've gravitated towards buying discounted mortgage notes, buying the debt on physical real estate, taking the place of the bank and collecting cash flow every month without having to be the landlord. And how cool is that? Now, let's talk about if somebody wanted to be a note investor and instead of buying, say, a rental property, they instead wanted to go ahead and buy a mortgage note and put a mortgage note in their portfolio. Well, what does that look like? I know you like to talk about the three outcomes. You like to talk about the fact that you're in control when it comes to note investing. And can you elaborate on that a little bit?
Sure. And well, first of all, when your notes are traded on the secondary mortgage market, and so when you want to buy a note, you're going to buy it at a discount, as Patrick just said. And what does that mean? That means that you're going to pay less for that note than the borrower or homeowner actually owes to the lender. So for example, if someone owes $100,000, you won't pay $100,000 for the note, you'll pay less. How much less? It depends, right? It's a negotiated amount, but it will be less, which means you're going to have equity right away. That was one of the first things I love about investing in notes, instant equity. But once you own a note, then at that point, only one of three things will happen. Either the people are going to pay you like they're supposed to, or maybe they'll pay you off early, or maybe they won't pay you. That's what happens anytime somebody owes you money, isn't it? Pretty much.
Absolutely.
Pretty much it.
They're going to pay you as agreed by your contract. They're going to pay you off early because they just want to get you paid off and they're sick of having the payment to you. Or maybe they just stop paying you and they say, sorry, I don't have any money.
Yeah, I had a conversation like that with somebody today, but now they say they have money again. They want to start paying again. So
that's interesting to say that you're in control with note investing versus sort of being out of control with stocks or maybe a market crash in real estate, because you just don't know when it's going to happen or how far it's going to crash. Let's talk about the control in these three outcomes. So somebody buys a mortgage note and they just buy the note to collect monthly cash flow, kind of like being a landlord.
Right.
And what does that look like? You said they could just pay as agreed. What does that mean?
Okay, well, let's just say, for example, a person has a $1,000 a month mortgage payment, not the taxes and the insurance, just the mortgage payment itself. You're going to collect that mortgage payment for the remaining term. Now, if it's a 30-year mortgage, that means for 30 years, you're going to collect $1,000 a month. That's freedom, okay? And if you have a lot of those, that's really awesome freedom, right? And so if they're going to pay you as agreed, that means they just make their payments for the next 30 years. Now, one of the things that I'd like to point out is that you don't have to keep a mortgage for 30 years, Patrick. You can sell it early, just any more than you have to keep a rental house for 30 years, right? Even though you have a 30-year mortgage on your rental house, you can sell it anytime you want. Same thing's true for this. So if someone pays their payments to me, then I'm going to earn a nice return on my money. And my return will actually be higher than the note rate that these people are paying. And that's kind of a strange phenomenon too. Should I talk about that a little bit?
Yeah, I mean, I think you mentioned that we buy these things at a discount. And so just for round numbers, let's say somebody owes Wells Fargo $100,000 and you want to go in as a note investor and take over that $100,000 worth of debt. But you're saying that you don't pay $100,000 cash to buy that debt. Yeah, elaborate on that.
Yeah, I wouldn't pay $100,000 for a $100,000 note. Wells Fargo will sell me that mortgage note for less than $100,000. And let's just say we negotiate to buy that mortgage note for $90,000. That means the day I buy that note, I actually have a $10,000 equity position because the homeowner still owes me $100,000, the same $100,000 they owed to Wells Fargo. And that's, people find that strange. And they say, why would Wells Fargo sell a $100,000 debt for $90,000? And the answer is, frankly, because that's just how it's done, right? We didn't invent this business or the model, but that's been happening for a long time. We'll talk about that maybe today, but that's how it's done. And so you'll go in, you'll buy it at a discount. And by buying it at a discount, now you're earning interest on the 90,000, and you're earning interest on the 10,000 that you didn't even put up. And so when you put those two together, the $90,000 that you invested is actually earning a very good return for you.
Yeah. Yeah. And then, so like we talked about earlier, these are backed by physical real estate. The promissory note is backed by physical real estate. And so it's an investment with collateral. And you talk about always that it's one of the only investments out there where you can get protection, because you're protected by collateral. You get a nice return, a good yield on your money, and monthly cash flow, and all three of those things in one place, right? And so that's what's so cool about it. Like you said, option one, if somebody buys a mortgage note, you could own one and they can just pay you as agreed. Means somebody's making their monthly mortgage payment on time every month for the next 25 years or however long is left on that promissory note. And you've got now nice collateral backed investment that you're sitting on that's spouting out $1,000 a month or whatever it were in monthly cash flow. And it's got that good yield that is comparable to the stock market and rental properties by net or even better, right?
Yeah, now, I find it better.
And then you said there's a second thing that could happen, which is maybe the homeowner pays you off early. Right. And there's a couple of reasons why a homeowner would pay off their mortgage early. Can you elaborate on that?
Sure. As we know, most Americans sell their homes or refinance their properties every 5 to 10 years. Just kind of statistically speaking, that's what happens. And so if I buy a person's mortgage, statistically, there's a high probability that they're going to pay me off. They're not going to pay me for the next 25 or 30 years. They're going to refinance. Maybe they're going to sell the property, or something will happen. Right? Maybe they'll hit the lottery and pay it off. But when they pay me off, now they will pay me off the $90,000 in my example, plus the $10,000 that I never even put up. So in addition to the monthly payments that I've collected during the time before they pay me off, now I collect the entire balance plus the $10,000 that was my instant equity in that deal to begin with. And when you put those numbers into a financial calculator, Patrick, I'll give you a good example. I have one that I did the other day. I was earning 10% if they pay me like they're supposed to, and I was earning 18% if they paid me off early. I mean, it's really a phenomenal boost to my return on my investment because they paid me off early and I collect that discount.
Yeah. And I know that's one of the things that people who love being a landlord may say to you is these notes, they eventually pay off, you get your cash back. And then what? Now I have this rental property that I'm planning to keep for the next 50 years. And it's always going to spit off cash flow. But you did cash in something in the 18 sort of percent return on your dollar. And as a professional note investor, you just put the money back out into another note deal at that time. Is that right?
Yeah, that's what you do. Yeah. You just put it right back out into another note deal. And if you want to use some of the cash that you're collecting each month, what I suggest to people is just use the interest. Don't touch the principal, right? We've all heard that. Live on the interest, right? And that's all I'm saying. Just live on the interest. You have plenty of interest there. Remember, mortgages, especially in the early years, is primarily interest, which is profit for you if you own the note. So, but yeah, I get the fact that, rental houses are forever income, but it's not freedom. There's more to it than money. There's also freedom. And I have a peace now that I never had when I was flipping houses or when I was a landlord. I have a peace that, well, how much is that worth? Right.
Yeah.
And I didn't have to sacrifice my return on investment to get that peace.
Right. In fact, I mean, and the other thing, the part of that piece, I believe that note investors tend to have is because, again, when we talk about other scenarios that are out of your control, and we talk about how you're well in control when you're in the bank's shoes as a lender in a mortgage note investment, that it bleeds right in perfectly to say, well, the one thing that people who are new to note investing always ask, Des, is the third thing that we were going to cover here,
Yeah.
which is if you owned a note, number one, they could pay you as agreed. Number two, they could pay you off early. And since you bought that debt at a discount, it usually ups your yield as an investor. And it doesn't mean anything bad at all for you. And the other third thing that everybody freaks out about, I think, Des, is like, well, listen, you buy this mortgage, a homeowner's living there. And what if they stop paying their mortgage payment? Because that can happen, right? People can become delinquent. And what happens then?
Happens all the time, right? It happens every day somewhere. Somebody stops paying their mortgage. That's why there are foreclosures. So, well, here's what happens, Patrick. If people stop paying their mortgage, you are their lender. You have a bunch of options, but worst case scenario is you say, you know what? I'm just going to take the real estate. And for me, that's always the last resort. My first option is to try and do something called a loan modification where I can get them back on track, get them paying again. But let's just say if we've gone through that and that's not an option for whatever reason. So I just take the property back. And the way that I do that is very simple. People think that's a big drawn out process. And maybe it is from a legal standpoint, but not for me. I'm the investor. What I do is I write a check for maybe $2,000 to a local attorney that handles foreclosures. They go to court. They deal with all the legal hassles. When it's all done, they give me something called a deed. It's normally called a sheriff's deed. And so it comes from the sheriff of the county where the property is located. And that deed gives me complete ownership of that real estate. And once I have that deed, I record it. All I need to do then is call a local real estate agent and have them sell the real estate. And most of the time, the real estate is more expensive, more valuable than what I have invested.
That's the beautiful thing. And that's why we get attracted to it because, and again, why are we saying it might be a hedge? Well, you're in control there, right? If the house or the collateral is worth far more than what you've invested, if it's coming with a monthly cash flow payment every month on a certain date, right? You've got that nice yield. The compounding effect of that cash flow could really take place and help you get wealthier faster. And it's just something that you're in more control of because, again, of all these exit strategies you have, you're really in control. You've got so many options, folks. Do a loan modification to help out the borrower and be a good person. Keep them in the house. Wipe debt off of the books with your pen because you can. You can save them from foreclosure. You can, do everything in your power to help these folks out. Keep your cash flow going, keep your yield up, and keep compounding. So that's the beauty. And here's what we're going to do, folks. We're going to go ahead and take our second commercial break. It's going to be fast. We're going to be right back on the Real Men of Real Estate radio show here with my guest, Desi Arnaz, talking about mortgage note investing. Do not go anywhere.